Hello, good morning once again. Welcome to the session. Today also we'll discuss the terminologies in accounting, but today a special area we'll discuss, that is rules of debit and credit. Actually, this is a little practical. We are slowly moving to the practical side of accounting. But this area, this concept, debit and credit, the rules of debit and credit is the most important from the in the total accounting. It is the most important. Yesterday we mentioned the different stages in accounting, from recording, classifying, summarizing, analysis, interpretation, and communication, reporting. Up to all these 6 stages, recording the transaction, the books of account, journalizing. It is done by using, journalizing is done by using the rules of debit and credit. So the starting of the first recording of the books of account, journalizing, is we'll do today after familiarizing the rules. So also this part, all other the stages will be automatically done by the system if you use softwares. There are so many accounting softwares, already. The computerized accounting softwares like Tally, ERP9, Peachtree, QuickBooks, SAP, Sage 50, like any software. If you are using this part, computer cannot do. This part you have to do, debit and credit. Computer cannot decide the debit and credit from a transaction. That you have, the accountant has to do. The rest of the from last up to reporting, up to analysis, like preparation of final account, income statement, balance sheet, and ratio analysis, fund flow, cash flow, all these type of analysis can be done by system. But recording the transaction, debit and credit, the accountant has to do. That is why this part is the most important, or the fundamental base of accounting. Another thing, if this part is very strong for you, the base, then it will help you in all the other accounting stages when you go ahead. So we'll discuss this. We'll go to the slide. So what is debit and credit? So we'll discuss, before discussing this debit and credit or the rules, you have to understand little about the history of debit and credit. You may be heard about Luca Pacioli. Is the father of accounting. He published a book in 1494. In 15th century, it means in 15th century, more than 500 years ago back. He published a book. The name was Liability Bookkeeping. He is the father of accounting. That is why he published in that book itself. In 1494, when he published the book, first book, Liability Bookkeeping, the debit and credit was mentioned in that. So it is not a new term. It is he was an Italian mathematician, but he published a book in accounting. He is the father of accounting, as you know. So this term, it is a very old term. In what context he used at that time, 500 years ago, the same we are using, but accounting, application of accounting has now it is widened. A wide application has become. So we'll go to the first. Another thing we have to understand, the basic, we discussed already that before that I will just mention the term debit and credit in Arabic. Arabic, it is debit means mudin, deen or mudin. Then for credit it is called da'in, creditors, da'in, or itiman. Itiman or itiman means credit, creditor means da'in. So this is the term you have to understand, because when you get this term, maybe you get easily the meaning of this. Anyhow, it is very connected. We discussed already dual aspect principle. Dual aspect principle means, what is the principle we discussed last class? That is, for every debit there will be a corresponding equal and corresponding credit. Equal amount with corresponding or equal or corresponding credit will be there. So that is a rule. That is a basic double entry or principle, or dual aspect principle. And also the another thing is accounting equation. Asset is equal to liabilities plus capital. That is also connected with debit and credit. So debit and credit, normal case debit and credit means if you ask someone, they will ask debit means the left hand side, credit means the right hand side. Because when we draw the T form, debit side means left hand side is the debit side. Right hand side of the account, T form means an account. Right hand side of an account is credit side. So you can just like that also you can answer. Debit means the left hand side of an account. Credit means the right hand side of an account. So this is a different meaning, but the when you go more ahead, you will understand more about debit and credit. That means debit means there are so many rules, traditional and modern rules are there that you have to understand. Then only you will understand the exactly what is debit and credit. Now debit means due to, or due credit means due from. In that way also you can understand it. If you have to pay some money to someone, you are the debtor. If someone has to give you money, he's your debtor, or you are the creditor for him. Or if you have to pay some money to someone, he is the creditor. That we discussed already yesterday. Debtor is a person who owes to the business. He has to give money to you. Creditor is the person to whom business owes. We have to pay some money to someone, or X we have to pay to X is our creditor. We have to get money from Y, and Y is our debtor. So this is normal understanding. And also if you go a little more further, there are debit the receiver and credit the giver. Debtor means the person who receives something. Creditor means the person who gives something. In that way also someone explained. And another most important meaning is debit aspects, or debit means increase in asset or decrease in liabilities. And credit means credit just opposite, increase in liability and decrease in asset. This also you can explain. Or debit means increase in expense and decrease or decrease in revenue. Credit means decrease in expense and increase in revenue. But this you will not understand now. After the rules we understand very well, I will explain about this. But you just now you understand, like debit means the left hand side of the account at an account. Credit means the right hand side of an account, or due to, due from. That also you can understand. So we'll go to the rules of debit and credit. So this is the modern rule. First we will discuss the modern rule, then we'll go to the traditional. Why? Modern rule is more recently more applicable, and vast applicability, or it is more useful and more meaningful than the traditional. But when we do the practical accounting, we'll use both these rules. If that is why the system, if you understand both the rules, it will help you easily to debit and credit, to identify debtor and creditor, or debit and credit. So we'll discuss. Here is for this purpose, for rules of modern rule or American approach, the total account we classified into 5 groups, 5 heads: asset, expense, liability, equity, and revenue. Once again, asset already, this is a very important area, so you should be very clear about asset. There are asset. What is asset? We discussed yesterday. Asset means anything which can be converted into cash, realized into cash. Or you can tell asset means things and properties owned by the business. Asset may be there are different type, but most important 2 type of asset already. One is current asset, another is fixed asset. Fixed asset is the asset which are used in the business for long time and which cannot be converted into cash within 1 year, and it is not meant for resale. Current asset means it is it can be converted into cash within 1 year, and it is meant for resale. These type of assets are called current asset. So anyhow, we are not, we are, example also, fixed asset example, very clearly, land, building, premises, vehicle, furniture, fixtures, like so many, all the assets which are constant, fixed, or which cannot be converted into cash, which are not meant for resale. So current asset example also, cash is the most liquid asset, and cash equivalent, bank balance, and short-term, very short-term or short-term securities. Then you have current asset like account receivable. Account receivable you have. Account receivable includes sundry debtors and bills receivable. And you have just like that other current asset, the prepaid expenses or accrued income, like that all we'll discuss later. Now you understand, any asset, if it increases, it will be debited. If asset decreases, it will be credited. So this is the rule. So just very important, you remember, when asset is concerned with an accounting, you have to check whether it is increasing or decreasing. If it is increasing, debit. If it is decreasing, credit. Then another is expenses. For expenses, different rule. Expenses also same. When expense increases, expense means any expense, direct and indirect expense, all we discuss. Any expense when it is increasing, salary or commission or wages, electricity or carriage inward, carriage outward, any expense, rent, insurance, commission, advertising, audit fees, or any expense when increasing, it will be debited. When expense decreasing, it will be credited. Then liability, already liabilities, masuliya, we discussed yesterday, dues and obligations of the business to outsiders. So when liabilities are increasing, it will be credited. Just opposite. When liabilities are increasing, it will be credited, and liabilities are decreasing, it will be debited. Equity also same. Equity, the owners, the portion of asset belongs to the owner's equity. Equity, when it is the components are will discuss, investment and revenue will increase the owner's equity, and expenses or losses will decrease the owner's equity, that we discussed yesterday, or withdrawals will also decrease the owner's equity. If equity is there, when equity is increasing, it will be credited, and equity is decreasing, it will be debited. Revenues also. Revenues we discussed already. There are two types of revenue: direct income or direct revenue, and indirect revenue. Direct revenue we discussed mainly sales, revenue from sales, and other direct revenues, service revenue. Direct from the revenue, direct revenue or direct income means the income earned from the business, which is by selling of or by sale of goods or service in which the business is dealing. For example, yesterday we very clearly mentioned, if you are a furniture merchant, if you sell furniture, the income from furniture, by selling furniture, if you get money, it is your direct income. But by selling an old car, if you are getting something, it is indirect. Or indirect income, the other indirect income we discussed, the rent received, discount received, commission received, dividend received, and interest received. This all received. So all this we discussed. So this is the rule. When you divide this asset and expense, remember, asset and expense. For asset and expense, when it is increasing, you have to debit. When it is decreasing, you have to credit. But for liabilities, equity, and revenue, three: liability, equity. Equity may be capital also. Capital also a part of equity. I distinguished it. We discussed it in different context. Capital for sole trading and partnership, it is called capital. For corporate sector companies, joint stock companies, it is called equity. So anyhow, liability, equity, and revenue. When it is increasing, you have to credit, and decreasing, you have to debit. This is the basic rule of accounting. It is called modern or American approach, modern approach. So this all will discuss one by one with example. Then you will understand more about this. For example, now after discussing the traditional rule, also we'll discuss first. Then after we'll go to the example. So traditional, or what you call It is called golden rule of accounting. Actually, this the other rule was it is introduced recently, maybe a few years back. But this is at that time most very old usage. That is why it is called traditional rule. According to traditional rules of accounting, what we are doing, total accounting, we classify into 3 groups: personal account, real account, and nominal account. So you have to understand it. What is personal, real, nominal? Personal, real, nominal. No need 5 group. In modern rule, modern approach, what we are doing, we divide into 5 group: assets, expenses, liability, equity, and revenue. Then we apply the rule. Assets and expenses, increase debit and decrease credit. Liability, revenue, or equity, increase credit and decrease debit. That is the rule there. But here we are dividing the total accounts into 3 groups, only 3: personal, real, nominal. Personal, real, nominal account. Then what do you have to understand? What is personal accounts? Are the accounts of person, companies, institutions, or banks, or any other. So company, it may be company, it may be person like X or Y. Person, company, banks, or any other institutions. It may be any institution, any college, or any what do you call companies, or any financial institution, insurance company, or any type of company is considered as under the personal account. So personal accounts. So first you understand, personal accounts are the accounts of person, companies, banks, or any other institutions. Then another is real account. Real accounts is real account is account of assets and properties. If the assets or properties are concerned, it is real account. Any kind of it may be current or fixed or any kind of assets. The nominal account is the accounts of expenses, losses, incomes, and gains. Expenses, losses, incomes, and gains. We discussed already what are the different type of expense, losses, incomes, gains. So we'll divide the accounts into 3 groups according to traditional approach: personal account, real account, and nominal account. Personal accounts are the account of person, companies, or banks, or any other institutions. Real accounts are the accounts of assets and properties. Nominal account is the account of expenses, losses, incomes, and gains. So this is the classification. After that, what we'll do, personal account, the rule for personal account is debit the receiver, credit the giver. If you receive anything, if in a transaction when you sold goods, the receiver, the person who received the goods, his account will be debited, debit the receiver. The person who give the goods, his account will be credited. So the personal account, debit the receiver, credit the giver. And in real account, what is the rule? Account is debit what comes in, what or which. Debit what comes in and credit what goes out. Real accounts are the accounts of assets and properties. When any assets comes to the business, debit it. When any assets or properties goes out of business, credit it. So debit what comes in, credit what goes out. The nominal account. Nominal account is account of expenses, losses, incomes, and gains. So according to this rule of nominal account, debit all expenses and losses, credit all incomes and gains. So this is the rules. So in accounting, the 2 sets of rule you have to understand very clearly. That actually this you have to by heart this. Without this rule, understanding the rules, you cannot go an inch ahead in accounting. So this is very, very important. So once again, I'll tell you the modern rule, most practically applied rule, or most of the countries or most of the people are applying this modern rule. So we divide the total accounts into 5 groups: assets. Then second, you tell expense, not liability, because assets and expense, there are same rule. We are applying the same rule. Liability, revenue, and equity, we are applying the same rule. So assets and expense, assets, expense, liability, equity, and revenue. 5 groups. Then what we are doing, assets and expenses, when increasing, debit, when decreasing, credit. Liability, equity, or revenue, when increasing, credit, when decreasing, debit. So this is the rule. Then modern accounting, golden rule of accounting, or traditional, traditional accounting rule. What it says, account we classify into three groups: personal account, real account, and nominal account. Personal accounts are the accounts of person, companies, banks, or any other institution. A company, banks, or any other institutions are considered as a person in the eye of law. So that is why it is considered artificial person. People, normal human beings are natural person. So artificial person or natural person. So personal account, debit the receiver, credit the giver. One who receives, debit his account. One, the person who gives something, his account will be credited. Then real account, what is the rule? Real account is the account of assets and properties. Debit what comes in, credit what goes out. Whenever something comes to the business, debit. Whenever something goes to from the business, credit it. The nominal accounts are the accounts of expenses, losses, incomes, and gains. In that, expenses and losses always debit. Incomes and gains always credit. So this is the accounting rule. Now we have to apply this rule in when transaction. Transaction, you know already, a business transaction. We have to apply this. Both these rules we have to apply. We'll try that to apply the rule. 1 minute. Go to the slide. We have slide here. A few transaction. We have actually we need to do a lot of transaction. If you do 100 transaction, different transaction, you will be very clear about the rule. So 100 transaction will take a lot of time. So what I do, we'll do some transaction, maybe 25, 30 or 40 or maximum 50 transaction. Then I will give the exercise that you can do, because this is practical side. You have to do practice. Practice only you can make you perfect. So here there are some columns. Here we are using this is a modern approach. Modern approach, how it is applied, we'll check modern approach, how it can be applied. So can you check about this transaction? Mr. Ali started business with cash 45,000. Ali is the businessman. He started business with cash 45,000. So our task is which account is debited and which account is credited. Directly you cannot decide. Even though you know the rule, you cannot apply. You have different stages. First, you have to decide two accounts involved in this transaction. In this transaction, there are two accounts are involved. That you have to identify. That is why the first stage in accounting cycle is identify the transaction. Identify or find out the transaction or two accounts you have to find. So Ali started business with cash. This is all actually when you practice only you will understand. When you do this, you will understand more about this. The two accounts are, one is Ali, but Ali's books of account, Mr. Ali is doing the business. In his books of account, his account will not be written. It is written capital account. So Ali's account, Ali the businessman's personal account is called capital account. So two accounts are one, then another is cash. Cash is going out. So two accounts are, one is cash and another is capital. These are the two accounts. So first, when you are getting a transaction, you have to decide which are the two accounts. That actually, this suddenly you cannot get it. When you practice more and more, you will understand. For example, anybody started business. Two accounts are cash and capital. The personal, actually the capital account is a personal account of Ali, but in Ali's business books of account, Ali's account will not be written. So it is written capital account or Ali's capital account. Some people write Ali's capital account. So this is in Tally also will write capital account only. Capital account and cash account, two accounts. The first. Then this is for deciding the rule. Debit credit we have to decide last, because before that we have to class of account, type of account. Cash is, you know already, it is an asset. It is a current asset. Cash is a current asset. Then capital is, you know already, capital or equity. Capital itself it is a group or equity. So it comes under equity or capital. You can write equity or capital. You can write capital itself, no problem. Capital, because capital and equity both are same. Or equity, if you want, you can write or equity. Capital or equity. So two accounts you got. In this case, if you get confused, you write capital only. No need to confuse. But you understand capital and equity both are same. In sole trading concern and partnership, it is called capital. But in case of company, any type of joint stock company, LLC, SAO, GSAOC, it is called equity. In balance sheet, there will be equity. Owner's equity will be there separately. So increase. Now you have to check whether increase or decrease. When Ali start business, his cash is increasing. His cash, Ali started business. He bring money and start business, invested in business. So cash is increasing. So increase you can write for the exam, for plus you can write. It is increasing. And capital, his capital is Rasulman. His capital also increasing. When Ali start business, when anybody make investment, his capital, his equity or capital increases. So both are increasing now. It should not be one increase and one decrease like that. But very essentially, there should be one credit and one debit. That is very important. Now you decide this when asset is increasing. Now you have to check asset is increasing, what to be done. What is the rule of when asset is increasing? We told already, asset or expenses when increasing, you have to debit. This is all you will understand when you practice more and more. The rules will be there with you, or you have to buy heart. Then you will understand easily. Now, second one is capital. Capital or equity increasing, it will be credit. So now you got already what account is to be credited and which account is to be debited. This is very clearly you got debit, cash account, credit, capital account. So if you got this debit and credit, once you got it is very clearly, correctly you got, then if you give in tally, if you give this debit and credit, the amount also will be there. 45,000 amount also will be. I'm not writing this now, the amount when we write the journal in the specified format, we'll write with the amount. But amount you can write 45, both are 45,000. Cash is 45, capital is 45, no problem. But the problem is to decide which account is debit, which account is credit. If you mistake this debit and credit, your total, total account will be different. That means you will not get correct profit, net profit, or you will not get correct assets and liabilities. It will be different and errors, different type of errors will be. It will be mistakes or errors will be occurred. So the first one you understood, when Ali started business with cash 45,000, there are two accounts related, cash and capital. First you have to decide two account. Then second you have to decide cash is which type, which class of asset. Cash is an asset, current asset. No need to write current asset specially. All the assets same rule. Increase means debit. So cash is asset and capital is capital or equity. It's a separate group. Or it is a same rule. It is if you think it is a liability also. But better capital separate group, capital. Now you have to think whether it is increasing or decreasing. When Ali start business, his cash is increasing and his capital, his investment in the business also increasing. Both are increasing. Now you have to check when asset is increasing, the rule is debit. When capital is increasing, the rule is credit. I hope you understood debit and credit. We'll practice this. The first entry we made, then second and traditional method also will do, then you will understand. He purchased goods for cash. He purchased goods for cash. Here you have to understand, whenever you purchase goods, goods means the things in which the business is dealing. If you are a furniture merchant, furniture is goods. If you are doing a mobile shop or electronic appliances, electronic dealer, electronics, buying electronics is goods. If you are doing any other, for example, vegetable merchant, buying vegetable is your goods. So Ali purchased goods. Whenever goods are purchased, One account is purchase account, purchases account. Second account is for cash. When it is for cash only, the second account is cash account. So these two accounts you got already. One is purchase and second is cash. As you know already, purchase is always an expense. Purchase is always considered an expense. It can be considered as it is goods, it is a stock is a current asset. It may be also asset also, no problem, but better it considered as an expense. The purchase is an expense. So you have an expense, and cash, already it is an asset. Cash is already an asset. Now the second is, you have to understand, you purchase goods and spend money. So your expense increasing or decreasing? Your masroof increase or decrease? Increasing. So plus. When your cash is increasing or decreasing? You purchase goods and paid the cash immediately. So your cash balance increase or decrease? Decreasing. Cash is decreasing, or cash is going out, or it is decreasing. So this is, you understood now. This is Ali purchased goods for cash. Two accounts. First you decide purchases and cash. Secondly, you decide the cash purchase is an expense and cash is an asset. Thirdly, you decide when you purchase goods and pay money, your expense is increasing and cash is decreasing, cash is going out. Now you apply the rule. Expense increase. What is the rule of expense increase? You understood asset and expense increase means debit. You will understand that when you learn the rules correctly. Then secondly, when cash is decreasing, asset is decreasing, it will be asset decreasing means it will be credit. Both are asset and expense, both are same rule. Expense increase or expense and asset and expense both are the same rule. Asset or expense increasing means debit, decreasing means credit. Expense here increasing, so debit. Asset is here decreasing, so credit. Now we will go to the next. Purchase of goods on credit from Niswa traders. From Niswa traders, you purchased goods on credit. On credit, that's a term. On credit or on account means didn't pay money. You purchased goods from Niswa traders and they agreed you will pay the money after 1 month or 15 days. They agreed. It means credit purchase. Purchased goods and on account, Malisa, or credit purchase, no cash. So the two accounts are, there is no cash in these cases. Cash there is not involved. Two accounts are, one is purchases. So there is no problem. Purchases is there in this account also. Purchases. So first account is purchase. Then another account is Niswa traders. Actually in Tally when you are doing, we are account is writing Niswa traders itself. But in other in HCCA the guidelines, we have to write Niswa trader is account receivable. So we can write account receivable also. Purchases, debit, and account receivable, credit. So this is account payable. That is purchases and Niswa trader. You can write normal case Niswa traders. Niswa. That I will explain. Traders. Niswa traders. Who is Niswa traders? The person to whom you have to pay money. If it is sold, it is okay. It will be accounts receivable. This is account payable. You have to. This is your liability that you have to understand. When you sold goods to Niswa traders on credit, money is not paid. So you have to pay money later. So you are the account payable or bills payable. Bills payable or account payable or sundry creditor. These all almost same term. So, but we are using account payable. So Niswa traders, or you can use account payable. That's also better to understand both, because accounts payable. Because some cases account payable you have to write, but in some cases Niswa traders is account payable. But in account payable, Niswa traders coming under the head account payable. So that's both you understand, Niswa traders or account payable. So now you understand the second stage. Purchase is an expense. You know already it is an expense. Purchase is an expense. And Niswa traders is or account payable expense. Niswa traders or account payable is a liability. Your mas'uliyat. So liability you have to write liability. Liability. So that is very important. Niswa traders, you purchase goods from Niswa traders on credit. You didn't pay money, so it is a liability. Now you got expense and liability. Now we'll go to the next area, that is expense is increasing or decreasing. Your purchase or when you have made a purchase, your expense is already increasing and your liability also increasing, because you are mas'uliyat, you have to pay later. So this is why expense is increasing. When expense increasing, you know already asset or expense increase means debit. Then liability increase means it is very clear, it is credit. So you have to you try to do the similar transaction I will give you later. You try to do yourself, then you will understand it very clearly. So purchased goods from purchased goods on credit or on account. On credit or on account, whenever you see on credit or on account, it means payment is not made. Sold goods on credit means you sold goods but money has not received. That means there is no cash. No cash. Nothing. Cash is transaction. If it is cash or credit, you have to understand very clearly from the transaction. So these two words you have to be very familiar, on account or on credit. If it is there, it means payment or receipt is not there. If it is sold goods on credit means goods are sold but no money received. If purchase goods on credit means goods you purchase but not money paid. Whenever purchase is coming, it will become, it is goods purchased on credit. Anything you purchase on credit, it become your liability. So account payable, liability is coming. Whenever you sold goods on credit, it will become receivable, account receivable. You will get money later, or sundry debtors will come in. So anyhow, you got it. Then we'll go to the next one. Ali, he means Ali took a loan from bank. 5,000 real, he took a loan. So what will happen? So 5,000 real, Ali is taking a loan from bank. So two accounts are, one is loan from bank or bank loan or bank, second is cash. So we can write first cash or second cash, no problem, you can apply cash and bank. These are the two accounts involved in this. Now cash, you know, it is an asset. Cash is always an asset, so there is no doubt in that. Then bank. Who is a bank? Bank is actually you took a loan from bank, or bank in bracket. Bank may be different occasion it may come. That is means you can write bank loan. Bank you are writing, it is for taking loan, not for depositing. So loan, bank loan is a liability. Bank loan, qard, it is called qard, it is a liability. So bank loan, asset and liability are there. Then whenever there is a bank loan, for one is asset, you took a loan, so your cash is cash is increasing, because cash is coming to business, so plus increasing. And your liability must also increase, your liability, because you have to pay the money later. So your liability, dues and obligations also increasing. Now you take asset increase. You know the rule, asset increase means DR, debt. Asset increase means debtor. Asset increase, debit. And liability increase means credit. Now you can understand, for every transaction there will be one debit and one credit. If from this itself you can understand you have done correct, right or wrong. If you are getting the rule, or after applying, if you are getting again one debit here, it means something wrong. You made wrong interpretation. Now purchase the building for cash. One thing you have to understand from this, you purchase a building and paid cash, it's okay. But purchase, the term purchases, you will write only for goods. When you purchase goods only, you will write purchases. In all other cases, you have to write the asset account. Building, car, or land, premises, furniture, fixtures, or anything you buy, that particular account, building account, furniture account, land account, premises account, fixtures account, like the respective asset account you have to debit. Only for purchase of goods or sale of goods you can be considered as goods. That means for purchase of goods you'll write purchases account. For sale of goods you will write sales account. Other all occasion you have to write the respective asset account. That is a basic thing you have to understand. Sometimes it may be confusing. Some student may confuse when purchased goods, purchases debit and cash credit. For purchase goods for cash, and purchased furniture, also purchase account debit and cash credit. No, furniture account you have to write. Here you have to write building account, buildings. Then another cash is paid. If cash is paid, cash account you have to credit. Now here you have to understand, building is a fixed asset. Building is a fixed asset. Cash is a current asset. But you need not write the nature of asset here. Cash is a current asset. Cash is an asset. Now you understand whether it is in building. When you buy building, purchase building increases. When you pay money, the cash decreases. So asset increase means, the rule. Asset or expense increase means debit, and asset decrease means credit. Asset or expense decrease means credit. So from these few entries, this is the basic rule we applied. Which rule it is? That it is a modern or American rule, American modern approach. So this approach is very, very important in accounting. This is starting only just a few transactions we made, and we'll make more and more transactions. You will understand more. I think if you go to the same transaction we'll apply the traditional rule also. Then try to understand both. Then we'll do more and more next class. More exercise we'll do. So this same transaction here, but traditional approach we'll apply the traditional approach. Traditional approach or same, whichever is approach to accounts, there is no change. So Ali started business. You have two accounts, already, cash and capital. Cash and capital. So there is no any differences in that, cash and capital. Now here class of account. Here class of account, you don't tell it is, don't decide 5 groups. There are in traditional approach there are 3 groups: personal, real, nominal. You have to check personal, real, nominal. Don't think about asset, expense, liabilities, revenue, or income. That is different. That is modern approach. So here you have to think cash is a real account. Real account meaning what? Account of assets and properties. So cash is an asset. So cash is real account. So it is a real account you have to write. Cash is a real account, and capital is only three accounts are there. There is personal, real, nominal. Capital is not asset. Capital is not expense. So capital is, I told in the beginning, capital account is the personal account of the businessman. So capital account is personal account. So this rule, if you find this rule is easier for you, you can apply this. You can apply all the transaction, any transaction, you will get correct rule. Debit or credit will be correct, exactly correct. There will not be any difference. It is option for you, but I think always you have to understand both the rules. The most of the college or school, some many places they are sticking on one rule, whether it is traditional or modern. But I think it is better you understand both the rule. Then there will be no chance for mistake if you understand both. No confusion in it, because sometimes the traditional modern approach will be a little difficult to apply. At that time, you can think it is whether receiver or giver, like that easily you can find. Now we'll think real account. What is the real account rule? Debit what comes in, credit what goes out. That rule, these two rules you have to keep in your mind. No need to write anywhere. Keep in your mind. That is very, very important. So real account rule is debit what comes in and credit what goes out. Now you think Ali started business with cash. So cash is coming in or going out. It is very clear. Cash is coming in or into the business. So cash is coming in. So debit what comes in. So you have to debit. Why you are debiting? What is the rule? What comes in. What comes in. So this is like this, you can understand. The first, this also will rule. The second also you will explain. The capital is a personal account. Personal account of the businessman. So when there is a person, whether the personal account, businessman is the person or giver or receiver. Businessman, actually we studied one principle, a separate entity or business entity concept. According to that concept, businessman and businessman both are separate entities. When businessman start business, businessman gives money and brings money and gives to the businessman. So businessman is the giver. In this transaction, in personal account, there are two rules only. Debit the receiver, credit the giver. So businessman is the giver. So giver account, giver, because of giver, his account should be credited. This is the rule. So giver account. So you understood now. Cash, the transaction, there is two accounts. There is no any difference, cash and capital. But the three groups, not five group in this traditional rule. So three groups are there. One is personal, real, nominal. So cash is an asset. So all the assets and properties comes under real account. So real, and businessman is the personal account of businessman is capital account. So it is related to the personal account. So in real account, debit what comes in. Whenever businessmen start business, money is coming to the business. So debit what comes in and credit the giver. And capital account, personal account, debit the receiver and credit the giver. Here, credit the giver. He has to credit the account. So you understood it, or you try to understand more. If you got the base, you try to understand more and more. Now the second one, purchase goods for cash. You are purchasing goods and giving money, giving cash. So you know already two account. We are not discussing about that. Purchases and another is cash. Cash, purchases and cash. So, but the group you have to decide. Purchases, no five group, expense, income, like that. Only personal, real, nominal. Expense, purchase is an expense coming under nominal account. So expense is a nominal account. Then cash, you know, it is an asset. It is asset coming under real account. There is no doubt in that. So cash is a real account. Now nominal account, before that you have to decide nominal account. What is the rule? Debit all expenses and losses and credit all incomes and gains. Here purchase is an expense. So debit all expenses and losses. Debit. Why it is debited? Because expense. Debit all expense, you can write debit all expenses. Debit all expenses. Expenses. So now we'll go to the second one, cash. Cash is a real account coming, but you have to understand whether purchase real account. Cash is a real account, you know already. And real account rule is what? Debit the receiver. Real account rule, debit what comes in, credit what goes out. You purchase goods and paid cash. So goods is coming, or sorry, cash is going out. Cash, what happened? You purchased goods and paid money. So cash is going out. So credit, what goes out? Credit, what goes out? You can write, because the rule is what goes out. I write it very clearly because to make it not to make confused. Why it is credit? Because the rule of real account, debit what comes in, credit what goes out. Here the cash is going out, so credit cash. Then now you are going to purchase goods on credit from NISWA. Purchase goods on credit from, that means purchase goods and money is not paid. So the two account, there is no change in that. Purchases and account payable or NISWA. NISWA traders, right? NISWA traders and purchases. So purchase, you know already, it is a expense. Expense come under nominal account. And NISWA traders, as you know, it is NISWA traders is a person. It is considered, you know already, the personal account meaning the accounts of person, companies, or banks, or any other association or institution. So NISWA traders are an association or institution. So it comes under personal account. Now you can tell it is a nominal account. Purchase goods, whether what happened, expense increase or decrease. Expenses, nominal account, or purchase, your goods are increasing or expenses increasing. First you have to understand nominal accounts are accounts of expenses, losses, incomes and gains. Then you have to understand here what happens, which rule is to be applied, not increase or decrease, that rule is different. Here we are checking whether the expenses, purchase is an expense. So debit all expenses and losses, or the expenses, right? So purchases all expenses, debit all expenses. So it is expenses. Now personal account, NISWA traders, you know already, personal account, debit the receiver, credit the giver. NISWA trader is a person who give the goods, so giver. Personal account, credit the giver, So credit the giver, that is the rule. Then next, these two more will do and stop, will continue next. So he took a loan from bank. When you take bank loan, two accounts are, one is cash, another is bank. So you took a loan from bank. Cash is an asset come under real account. Bank is considered as a person, or bank balance can be considered as an asset. Both the way it comes the same rule. Whether it is personal account or debit the receiver and credit the giver, or you apply any rule, but it's better bank always in this group. Bank you can consider as a personal account. So real account, cash, you took a loan. When you take loan, or a real account rule is no need to increase or decrease. Don't think I by mistake think about the modern approach, because we are all most often or always apply the modern rule, but this only you have to understand. If you find it easy, you can apply this rule. So real account rule is debit what comes in, credit what goes out. So cash is took a loan. When you take a loan, cash is coming in. So debit what comes in, This is the rule. This actually you need not write. First time we are doing, that is why I am writing the rule also, why it is debit. Then personal account, the bank is a personal account. Bank is the giver, right? Credit the giver. CR, bank is the giver, because the bank is the giver. Now this is a purchase building for cash. You know, to account there is no change. Building and cash. Then building is an asset come under real account. Then cash is also coming under real account. Now you have to check real account rule, debit what comes in. Building coming to the business, so debit what comes in. what comes in, and real account cash is going out here. Credit what goes out. So these are the rules we applied. This is actually, this is both the rules. If you understand, it is not that much, but the most important thing, it is the basic, most basic and very, very important area in accounting. If this is, you have to do as much as possible transaction, you have to make debit and credit and make it very familiar. So we'll do next class also, we'll do more, a little more transaction. One complete session we'll do the, because this is once you understand this, you can go ahead without much difficulty. Because the journal is not a problem. If you understand debit and credit, you put in format, in the specified format, it is journal. So making journal or the format is no problem, but only the main problem is deciding the debit and credit. The amount also no problem. 7,500 debit, 7,500 credit. Or here cash account 55,000, bank loan 55,000. That's all. Amount also same you can write. But the most important thing, you have to little think, you have to think also, it is to decide the debit and credit. So I hope you understood the basic, some idea. Not you are not fully understood, I am not thinking, but some idea in debit and credit, and how to make debit and credit, or how to apply the rules of debit and credit, or how to journalize the transactions. All transaction, any transaction, you have to convert into debit credit. For example, now some transaction related to asset, some may be expenses, incomes may be there, liabilities may be there, revenues may be there, equity or capital may be there. Any five broad head, any transaction connected to this, you have to practice. All this transaction we have to practice, then you will be very good in. This will help you to understand all the other stages in accounting also. So once again, thank you. Thanks a lot. We'll stop here.